Good morning and welcome back to Almus Market Mornings. We start the week from the hall of updates from the weekend, starting with, of course, the US-India trade deal. Now, both countries have released a joint statement which has provided some more clarity on where the entire tariff situation stands. Interestingly, the reciprocal tariff has been removed completely on generic pharmaceuticals, gems and diamonds, and aircraft components, of course, subject to the agreement in the interim deal. Moving on, the RBI, apart from keeping its rates and stance unchanged during its decision on Friday, also released some measures to improve long-term participation by FPIs in the bond market by merging VRR caps with the general route, providing FPIs with higher limits to purchase debt. This, of course, is expected to improve some more inflows into the market. How it pans out, we'll see. Good morning, JK. A lot of domestic developments. There are some international developments also with the Takaichi election victory. How are we seeing all of it impact the market?
Morning, Swaraj. So, yeah, you said said it right that there have been quite a few factors and events that will have a say in the Indian markets. And one of them, of course, that came about over the weekend was the interim deal signed between India and US officials. So it's a progress from the political statement of intent from the leaders down to something in black and white. Many things are specified, including the products, rates of tariffs on most of them. There is some ambiguity also that remains. Clearest winners in Indian side is the gems and pharma sectors. Now, as trade policy increasingly overlaps with strategy, India has to watch out for market access with the enforceable reciprocity. So actually, there is the debate still is on, or rather, opinions are divided as to who has gained more from this deal, and that, I think that will be going on for some time. And one glaring question as far as India is concerned is whether it has committed to stop Russian oil import completely, as that is a condition for removal of 25% penal tariff. And there is no answer from any quarters in this regard. So there are some open things, but yes, we have progressed, and we know that the tariff is now down to 18% from 50% for most of the products, and that certainty will be a positive for the market. As far as MPC is concerned, we had already mentioned that it's probably not going to see any major changes except some regulatory changes, and that of course is in favor of the markets. As far as their projections are concerned, the GDP for FY26 is revised at 7.4%, and the CPI projected at 2.1%. But as far as FY27 is concerned, both CPI and GDP number projections have been held back in order to see the impact or to await the implementation of the new series of GDP and CPI that will be implemented. And just for perspective, the India is about to adopt a new series for both of these calculations, and it's a significant methodological update that will change how the headline inflation and economic growth are measured. It actually reflects the modern consumption patterns and the investment patterns as well as to reflect more real-time and digital data sources. So that's the reason why RBI has held back their projection. Probably once it is implemented in and the next meeting, perhaps we will have the projection. However, it's broadly, if you go by what the various agencies and the government are saying, and growth should be strong, way above 6-7% next year as well. Other important things in the Indian market, which I would like to touch upon is the FX reserves touch a new all-time high at 723.77 billion. And this is the second successive week when a new high has been touched in the FX headline reserves. Let's remember that it's only the headline reserves, not the net reserves. And this increase happened with the increase of nearly 15 billion in gold reserves. So why I said it's a headline reserve is net reserve will comprise of forward maturities, which should now be in excess of 85 billion. Therefore, net reserves will continue to be around 240 billion odd. Also, one more positive development last week was a shifting FII flows from negative to positive, and as much as 1.71 billion of FII flow positive was seen last week, and details shows that inflow was there for both for equity and the debt market. So we just need to wait and see whether this becomes a trend as well. Beyond these India-specific factors, the global sentiment itself took a big boost, starting on US late evening on Friday when Dow Jones crossed 50,000 mark, and it dragged also the other indices higher. But Dow rallying by 1,200 points, comprising of old economy stocks, it was very significant, and that has spilled over into the other Asian markets today morning. And Asian markets themselves have been higher, particularly in Japan, almost 5% higher after Takaichi has won, absolute majority if you count the coalition partners numbers as well. And this is a very big boost for her political agenda to be pushed in the coming months. She has been pushing for consumption tax cuts to boost the consumption, as well as to spend a lot on defense. Japan itself is trying to reassert its own self defense, so you can expect a lot of spending by Japan. No doubt it's going to have some impact on the fiscal, as well as the yields will be seen higher as well. But right now the market is looking at the positives of these, and the Nikkei has rallied, as I said, more than 5%. Other markets like Korea and all are also substantially higher. India's own Nifty future is showing about 200 points plus. So India rupee can see some positive reactions in the market due to all these factors. However, I still feel it should be in the range between 89, 80, and 90, 80 for the near term, with the two-way interest from corporates. And as we have been emphasizing, more sustainable strength in rupee requires consistent capital flows. We have seen some start of the positives in this month, but we need to see whether it remains consistent. We also need to see as to RBI whether they're comfortable with allowing more rise in the rupee, even as exports struggle to pick up, and and the level at which they look to rebuild their reserves. These are the factors that rupee will have to consider before we see any directional indication emerging. So on Friday we also had something to cheer about in the US, because the entire week we had seen very downbeat data on employment. Michigan Consumer Sentiment Index rose by 0.9%. Importantly, the inflation expectations for the short term came down from 4% to 3.5%. That was a good development as far as US is concerned, and adding to the positive factors for the stock market as well. However, I think there is more and more attention being given to the softening labor market data, and the PME's Fed Watch tool is now showing 82% probability of a rate cut in June. Market is already discounted two rate cuts by US, while authorities, particularly the Fed members, remain very cautious, whereas the administration wants a deep rate cut as well. For the broader dollar, what was noticeable was that the interest rates, US interest rates, did seem to react to some of the softer labor data, but it still remains in the range. So that actually is keeping the dollar also in a range. As I shared in our earlier podcast as well, the statements from other countries, particularly in Europe, where they are actually resisting strong rise in the euro, in a short period of time, which will have an impact on their exports and possibly lead to disinflationary pressures. So that is the reason why it has supported the dollar as well. But broadly, I don't see a big push in the dollar on either side. For some time more, we should see consolidation in the dollar. More attention, of course, will be given to Japanese yen, which has, of course, seen some profit taking on the longs, because we had seen dollar yen slip to 152 earlier, some a couple of weeks back, when there was a rumor about rate checks by Bank of Japan as well as the Fed. But those rumors were denied by Fed, and of course, ahead of the elections, dollar yen had rallied to 157 and a half. There was some profit taking in the morning, and also statements of concern by Bank of Japan authorities about the one-way rise in the dollar yen, saying that they are watching the matters very closely. So market will be cautious, but for it to slip down again, I think we need some action from the Bank of Japan authorities. Until then, I think yen will tend to weaken, mainly because of the fiscal concerns. This week, of course, we have the non-farm payroll data on Wednesday, and that's actually been postponed from the scheduled date on account of temporary shutdown of the U.S. government. And this number will be very closely watched in the background of a very soft number on various indicators that we got last week, and any decisively weak number from US can actually see the interest rate cut expectations rising, and the dollar itself taking some hit. So that is the main focus of this week. Thank you.
Thank you, JK. Yes, as you mentioned, non-farm payroll will be closely looked at and how the jobs market is doing in the US. But starting this week, we are starting on a very, very positive sentiment, both for the domestic markets and internationally. Globally, on Friday, we saw a strong rally by Dow Jones, rallying by almost 1,200 points, and that has spilled over to other Asian markets. Japan is also 5% higher. This is, of course, after Takaichi sweep, the election for lower house. That would mean that more fiscal spending is about to come in. On the domestic front, of course, we got some clarity on the India US trade deal after a statement was released, a joint statement was released by both the countries. As of now, clear winners seem to be gems in the pharma sector, but there are divided opinions on who has gained more from the deal. One other clarity which is awaited is whether India has actually decided to completely stop its purchase of Russian oil. That would also be something to watch out for. Apart from that, we had the India's headline reserves at all-time high of $723 billion. There has been an increase of $15 billion in gold reserves. So that's something. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.